Welcome back to the Academy. And where do interest rates come from? Part two. Let's just start with a slightly lengthier example, but nothing too strenuous, I promise. So this time we have our forward rates, and these forward rates are based on expectations. Expectations are what we think is going to happen with the general economy and what's happening with inflation, et cetera, et cetera, et cetera. So this is the forward curve made up of forward rates. We have the first rate for the first year, that's 4%. And we believe that the rate for 2 years is going to be 5%, the rate for 3 years, 6%, and of course, 4 years, 7%. So from those rates, based on our expectations, we've created the forward curve. And we're going to work in the opposite direction to what we did within part one. So what we're going to do is we're going to take those forward rates and from them derive zero rates. And you can see how we do this. So obviously for the first year, the rate is 4%. We already have that. But what we need to do to calculate the 2 year zero rate is we're multiplying those rates, the forward expectations. We've got 4% for the first year, 5% for the second year, and we're going to take the square root of that to come back with the 2 year zero rate, where the zero rate should be, again, based on our expectations. We do the same thing for the third year. So we take the 4%, the 5%, and the 6%. This time we're going to take the cube root, the third root of this, and we have the 3 year zero, 4.997%. Now, I'm being very precise with these numbers. I could round up. It might be nice to round up, but I'm using these exact numbers because of something I'm going to show you in a little while. So please bear with me on that. So the 4 year zero, we'll take those rates, 4%, 5%, 6%, 7%. We'll take the fourth root, and that gives us 5.494% as the 4 year zero rate, again, based on our forward expectations. So once again, we're using this to analyze whether we, take a particular situation or not, whether we go for a particular investment or not. So we now have our forward expectations of rates based on what we believe is going to happen. And from that, we can get back to where we believe those zero rates should be. Now, from that, of course, we had our forward curve to begin with, and we've now created a zero curve. And the zero rates are very, very important when you're thinking about discounting future cash flows. And we mentioned this, of course, in part one. So when you have future cash flows and you want to know what they're worth today, then we need our zero or spot rates to do just that. And we can use the rates themselves, or of course, we can compute discount factors and instead use those. So based on our zero rates that we've just calculated, as you see right here, we can calculate the various discount factors. We could use those. They might be, as I said in part one, a little bit more palatable in certain cases. Now, from this, let's now reverse everything again and pretend that we had these zero rates to begin with. Now we're going to work out forward rates. But of course, we did this already in part one. You know how we did this. If you missed part one, please go back and have a look at it. So in part one, we took these zero rates for these various periods, and we, from those, calculated our forward rates. And you can see just how we do this. And of course, we already knew because that's how we began our story in this part two. But it's also useful for working out perhaps uneven periods, so to speak. So again, for simplicity's sake, what we're going to call the 1 times 3 forward, that's a 2 year situation that begins in 1 year's time. So that's what we're going to call the 1 times 3 forward. And you can see what we're doing here nicely. We're going to take that 3 year rate, and of course, cube it, and we're going to divide it by the 1 year rate. And that gives us, for this period, this 1 times 3 forward period, a rate of 5.5%, 5.5%. Okay, so nice and easy in that way. But of course, as we've already said, you can use your discount factors. So we can take our discount factors and use those. So take your 3 year discount factor, divide that by your 1 year discount factor. That gives us a new discount factor, which when we apply it in a calculation, again, proves that we were right. It's 5.5%. Okay, so just before we go further on this exercise, let me introduce this. So what I've created here is an Excel spreadsheet based on the numbers that we've been using just previously on the slides. So we started, of course, on the slides by taking our zero rates from our forward rates. There were our forward expectations, 4% first year, 5% for the second year, third year, fourth year. We've got those expectations. And from those, of course, we can derive our zero rates. And you can look at the slides to see how we do this, or you can look at the Excel spreadsheet formula here. That's what we have done. So what we've done is add 1 to that 1 year forward, multiply that by 1 plus the 2 year forward, and then take the square root to get the 2 year zero. And likewise, for the 3 year zero, we're going to take that 1 year forward, the 2 year forward, and 3 year forward, multiply them together, and then take the third root, much as we've done on the slides. And then we can take those zero rates, and from those, we can work out our discount factors. And you know how it's done. We just simply divide 1 by 1 plus that, or in this case, 1 year zero, 2 year zero, so on and so forth. But again, remembering the right time periods. And then we kind of reversed everything. We said, right, okay, imagine if we started with those zero rates. Can we calculate our forwards from those zero rates? And of course we can. And we did this first off in part 1. So all we've done here is reverse what we did just above. So for example, if we wanted to work out the forward from the zero rate here, the 2 year forward, then all we're going to do is we're going to take those zero rates and calculate our forwards, much as we did in part 1. And of course, you've seen how we've gone through all of that. And you can use it, as we've done in this very part, when you're looking at uneven periods like the 1 times 3 period. So that's a 2 year situation that begins in 1 year's time. So a rate for a 2 year period that begins in 1 year's time and ends in 3 years' time, what we simply call in these exercises the 1 times 3. And we worked it out, as you saw previously, to be 5.5%. You can see the formula above. Okay. Now, from these forward rates, our forward expectations, what we've done over here is create our forward curve. And you can see that there, the purple line there, that's our forward curve. From those, we've derived our zero rates, and we've created our lovely zero curve. Nice in that way. There's a red dot here. I'm going to hold the explanation on that for a few moments until we go through the rest of the exercise. But so far, so good. Hopefully you're seeing how we can easily use the Excel to do what we've been doing effectively manually on the slides. But I'm going to come back to this spreadsheet very, very shortly. But in the meantime, let's go back to the slides. Let's take all of that lovely information and put it into an application. But just before we do so, a quick recap. So remember, we started the story in part 1. We've continued the same story in part 2. If we have our zero, otherwise known as spot rates, then of course from those we can derive forward rates. And as we proved in part 2, if you've got forward rates, then from those you can derive your zero rates. Now your zero rates are required to discount any future cash flows. Ideal in the world of investing when we are typically faced with future cash flows and we need to know the present value of those. We need to know what that future cash flow is worth today. Now we can calculate this using the zero rate directly, or of course, as we've done numerous times, we compute discount factors and use those instead. As I say, if we start with our zero rates, if we've got those, then we can work out forward rates from those. And these are required to derive what we call a no arbitrage market expectation of future zero rates. But the problem, as we mentioned back in part 1, sometimes these aren't fully observable. So if we haven't got something, how can we work something out from that? So in this situation, we're now going to find and talk of something that is observable. And what I'm dealing with in this example is a bond yield or a bond rate. Now, these are observable because these products are trading. There's constant buying and selling going on. So we have price discovery. And from that, of course, we can derive the yield. The only issue that we have with yields and swap rates for that matter, but we'll discuss that on another session, is these don't contain what we call term structure information. They don't contain term structure information. So they can't be used for general discounting. They're perfect to use on that particular product, on that particular bond. But I'll say again, we can't use them for general discounting. We need those zero rates for that purpose. Okay, but we have something observable, and the question we need to ask is, can we derive other rates from something that's observable here and then get to use those rates? And the answer to that question is yes. So follow me through on this example. We've got a nice simple example here of a fixed coupon bond. The bond has a life of 4 years. This bond has a coupon of 5.43% per annum. That's a rather precise number. Normally the coupons or the numbers are rounded, but just work with me on this example. You'll see why I've done this in a few moments. And this bond has a face value or a nominal value of $100. That coupon is a percentage of that nominal value. So the expected future cash flows on this product would be $5.43 at the end of year one. That's 5.43% of the $100. We'd expect the same at the end of year two, the same at the end of year three. And on the final year, what we're going to get back is the last coupon plus our 100 nominal value. So we get back a total of $105.43. These are future cash flows. What are they worth today? Now, what we're going to use to work out those present values, the zero rates that we've calculated through this second part. So we've got a 1 year zero rate, effective 4%. We've got that 2 year zero rate of 4.49%, and so on and so forth. So we're going to use these zero rates to work out the present values on this bond, what these future cash flows are worth today. So that cash flow that is due at T1 is worth today $5.22 with rates at 4%. Now, we're getting used to moving backwards and forwards, and we could also do the same thing here. If today, T0, we had $5.22, and our bank offered us a 4% return on that, if we deposited the money there for a year, guess what we're going to have? We'd have $5.43. Likewise, if we took the second cash flow and the present value of that is $4.97, if we put that into a bank that was willing to pay us 4.49% for both of those years, guess what we're going to have? We're going to have $5.43. So we can discount to get back to a present value, and we can take those present values and compound them forward to work out future cash flows. Fairly straightforward stuff. Okay, now we've got these present values, and to work out the bond's price, it's simply a matter of adding those all up together. So the bond's price is simply a sum of those present values. Now, in this situation, because we've used these numbers, the bond's price is exactly the same as its nominal value. That means this bond, in market terminology, is said to be trading at par. It's trading at its par value, its face value. So if we had a number that was below that nominal value, the terminology would be that the bond is trading subpar. And likewise, if we were trading above that nominal value, we would be trading above par. So this is terminology that we're just introducing here on this fixed income bond. Okay, now think about these rates. What if our rate expectations change? What if, for example, we expect inflation to suddenly pick up, to go higher and higher and higher? What happens perhaps if we start to think about credit risk and the chances that we may not get these future cash flows because the issuer, the borrower of this money that we've given them goes bust, goes into default? So rates are constantly changing. Our views on rates are constantly changing for a variety of reasons. And if we think those rates in the future are going to go higher and higher and higher, then we'd end up having higher zero rates in our calculation. And if we've got higher zero rates in this particular calculation, it means our present values would surely be lower than we see on the screen right now, because we're dividing by larger numbers. And vice versa. If we thought that rates were going to go down in the future, going to go down over the life of this bond, then we would be discounting using smaller numbers. So those present values would increase. And as the bond's price is simply a sum of those present values, the bond's price would go up. So what we have here is this inverse relationship between rates and bond prices. As rates go higher, for whatever reason, then the bond price must go lower because everything else is fixed. The time period, the maturity period here is fixed. The coupon is fixed. The nominal value is fixed. That's why they call it fixed income. So the only thing that can change, of course, if the yield, our interpretation of rates changes, then the only thing that can change, of course, is the bond's price. So the inverse relationship. But we wanted to work out, of course, this thing that we call the yield to maturity. Now, to recap the story we started in part one and we've continued throughout part two now, those zero rates are averages of the forward rates. And the yield to maturity is actually a weighted average of these zero rates. It's a weighted average. Let's get into the weights on this bond. We're talking cash flows, of course, and the largest weight on this bond is, of course, the cash flow that happens right at the end of this bond's life, the $105.43. So if we're taking a weighted average of these rates, that T4, that rate that we have in that fourth year, is going to be very close to our yield to maturity. It's a weighted average. So our yield to maturity should be close to 5.49%. And indeed it is. It actually comes in at 5.43% per annum. That's our yield to maturity. So that's a weighted average of those zero rates. And that's our yield to maturity. That's what it's all about. Now, again, think back to how we started this application. We were talking about the fact that these rates, these numbers are observable because this product is constantly trading, but that number is only useful for this bond because it's a weighted average. It's one rate. So we can't use it for general discounting as we have done before with our zero rates. But what we can do is we can use that rate to discount these cash flows on this bond. So taking it to the final example here, we've got that 5.43% yield to maturity, and we can use that to discount these future cash flows. Obviously paying attention to the time period here, but now we have these present values. But again, if you add up all of these present values, you come back with the same result, $100. But this time, what we've used is that yield to maturity. We've used the yield to maturity as a discount rate on these future cash flows. And if we go back to our Excel spreadsheet and you cast your eyes to the bottom left-hand side, we can see our lovely bond example here. So our bond has 100 nominal value. It has a coupon of 5.43%. And you can now realize, of course, why I used that coupon, why that exact number, because I wanted to equate it to the weighted average of those zeros. So we would have a bond's price of exactly its nominal value. So the bond would be trading at par. And that's why I use those particular numbers. So we have the coupon there. We have the time to maturity. And of course, this is an annual coupon bond, an annual paying coupon bond there of 4 years. And the bond's price there, it's a negative number because this is the money that we would have to spend. This is an outflow to purchase this bond. And we can work out from this our yield to maturity. And you can see the formula up here. You can see the formula at the top here. That's just simply the internal rate of return formula for the yield to maturity. It's the same thing. So we can take our cash flows as we have done on our slides, and we can take those zeros and calculate our present values. And you can see there with the sum of those present values being the bond's price. Or alternatively, as we proved on the slides as well, what we can do is take those cash flows and simply work out the present values of those using our yield to maturity and come back with the exact same result. Now, I'm going to make this spreadsheet available to you. It'll be on our website, and you can play around with this if that's something you fancy doing. And you can, of course, change things to prove what we've been saying within the recordings. So let's say, for example, I'm going to take that 2-year forward expectation and I'm going to make it 6%. So rather aggressive hike there. Let's make the 3-year forward expectation to be 7%. And let's make the final year 8% in this example. And look what it does to your bond's price. Okay. What it's doing is changing those zero rates. You can see that. You can see the zero rates have changed, and of course the discount rates. So it's going to change all of the scenario when we were calculating our forwards from zeros, either using the zero rates or the discount factors, and you can see how your bonds price has changed. As the bonds price has gone down, as you would expect with higher rates, then you're seeing the yield to maturity also increasing there. The bonds price has gone down, you're seeing the yield to maturity increasing. And that's our inverse relationship. And you can see it through the calculations here, either using zero rates, which have changed because our forward rates have changed, or of course, you can see the same result through using the yield to maturity. And you can see the curve changing slightly here as well. Or what we could do is look at the reverse of that. So let's take that 2-year rate down to 3 3/4. Let's take the 3-year rate down to 3.5. And let's take the 4-year rate down to 3 1/4. And that's the scenario we end up with. Of course, what we're seeing is the bond price goes up. We're now discounting using lower rates through these expectations we've seen here. And you can see your yield to maturity with the price going higher. Then, of course, your yield to maturity is going lower. Good. All right. That bonds price, incidentally, is rounded up, but you get the idea. You can see the bonds price below quite effectively through the calculations. Hopefully this is all making sense, but let's again finish with a recap of the key points that we began talking about all the way back in part 1, and we've continued to part 2. Zero rates are averages of forward rates. And as we've just seen, the yield to maturity is a weighted average of those zero rates. We also mentioned that if the bond is trading at par, at its nominal value, then this yield can also be described as the par yield or the par rate. And the par yield, the par rate, is the swap rate. When we talk about interest rate swaps, that's the par rate. And we'll discuss this in future sessions. As we saw, the yield to maturity is driven by price or vice versa, but the par rate is derived from zero rates. So when we go to talk about swaps, interest rate swaps, you're going to see how this is all going to pan out. But remember, some of these rates are not fully observable, but we've now just proved that we could take something that is observable and from that kind of work it backwards to find these other rates that we need. It's known as bootstrapping. We bootstrap. And what we did, or what we thought about, what we were aiming at with this particular application was the ability to bootstrap that yield to maturity that we calculated and taking it back to zeros. Now, if this is something you're interested in, we'll go through a bootstrapping example. We'll go through another recording on bootstrapping. You can see how we can do this. And you can bootstrap yield to maturity. You can bootstrap par rate. You can do a lot of these things, but we'll discuss that in that further recording. And again, if you're interested in more bond pricing, swap pricing, please stay tuned. We have some recordings coming up on all of the things that we have dealt with on these two parts in terms of where the rates come from. And also that Excel spreadsheet, I'll make it available for you on the website, and you can play around if that's something, again, that you're interested in. So I look forward to seeing you again in the future recordings when we go through some of these topics.